Good day, everybody. Gbenga Olatunji here. Let's look at audit planning part 2. Audit planning part 2. We shall continue from audit planning part 1. For those of us that are just joining us, please, you need to go and search for our audit planning part 1 video so that you'll be able to continue from here so you can build up the knowledge. So this is the slide we are going to be using. And I think we can move on now. Audit planning part 2. So we stopped last time, audit planning part 1, at types of risks. And now we'll move on to the model of risk models and the like. So in this audit planning part 2, we are going to examine types of risk. We are going to study materiality, the materiality threshold, what is material in audit, what is immaterial, the judgment of auditor in determining what is material and immaterial. Also, we are going to consider materiality versus performance materiality. Are they the same? Are they different? These are the things we are going to learn. Also, reporting non-compliance to those charged with governance. We are going to examine the qualification of audit opinion. How do we and why do we qualify our expression of opinion? And when we do not qualify it, why? Also, we are going to examine reporting non-compliance to the authorities. And who are the authorities? What is non-compliance? How do we report them? We are going to examine also audit risks. Also, we are going to examine what fraud is and what error is. What is fraud? What is error? Last but not the least, in this part 2 of audit planning, we are going to examine what should auditor do when fraud is observed. What should auditor do when fraud is observed? Okay, so this is G. James Associates. Subscribe to us. Want to believe you're enjoying the video and you're going to enjoy this part 2 more. Like, click the subscribe button, keep following us. Let's build this community so that people can learn more freely. A value to your life, we have value to your business. So we move on. Types of risk. Like in the part 1, we've discussed this, so we'll just move on, or I just highlight it. We have inherent risk, we have control risk, we have detection risk. Inherent risk, control risk, detection risk. Materiality versus performance materiality. So what is materiality? Or when does something become material in audit? Information is material if its omission or misstatement could influence the economic decision of a user. If that information is not there, or is there but not in the right measure that it should be. If such an omission or misstatement could make an end user of our audit report to be misguided, then it's a material misstatement. And we need to take cognizance of it. So, therefore, when we are talking about materiality, we must consider how large, how big our client is. So, what is material to company ABC would definitely not be material to company XYZ. And this calls for auditor's judgment, practitioner's judgment to determine materiality. And materiality must be determined during the planning phase of the audit, known as the execution stage. Materiality must be determined at the planning stage. I want to believe when we hear IASA, we know what it means now. We know what it means now. So we know what it means now. Materiality must be set at the onset of planning, not at the execution. And when we are setting materiality, we must consider the end user, we must consider how large the organization being audited is. I read from our slide. At the planning stage, the auditor must determine materiality for the financial statement as a whole. So, the financial statement of the organization, which must be segmented, that is broken down into its compartments. This is often referred to as the materiality level or materiality threshold. So when we are talking about materiality, we are talking about materiality threshold. When we are talking about threshold, it simply means we are setting boundaries. Threshold, we are setting limits. So materiality setting is all about setting what risk or what will eventually become risk to the audit or to the success of an engagement, or could make the end user to be misguided as a result of our incorrect opinion. So that is materiality. So materiality comes to play, or materiality threshold comes to play at the beginning of an audit. Like our topic, materiality versus performance materiality. So now that we know what materiality is, let's move on to what performance materiality is. Unlike materiality threshold, performance materiality simply deals with the end result. For materiality threshold, it looks at, okay, when we are executing this assignment, these are the limits. Let's say anything above 500,000 becomes material, and we must thoroughly check it and test it. That is at the onset. Per segment, the current and non-current, the cash balance and things like that. P&L, expenditure head and things like that. All must have their materiality threshold. But at the performance materiality, we are looking back. I think it should be simpler now if I say at materiality threshold stage, we are looking forward, planning this is what we want to do. At the performance materiality stage, we are looking back. That is, we are taking a step to see whether we achieve materiality, or we go beyond boundary or above boundary, which has liability consequence. So performance materiality is looking back at our work, the aggregate of our work, and performance materiality is all about, at the end of the day, if those that we thought are immaterial items, if we aggregate them cumulatively, do they become material? That is, do they amount to significant figure after the execution? So that is performance materiality. So it simply deals with performance. Materiality deals with planning. Performance materiality deals with performance. That is, after all has been said and after all has been done, what result did we get? What do we arrive at? So I read from a slide. Performance materiality, simply put, means when immateriality in the performance of an audit becomes material when considered as a whole. That is, cumulatively, if something that is negligible in part A or the financials, let's say the part A is the current assets, the part B, another segment, non-current asset, and the like, when those insignificant items cumulatively results to a significant figure after the execution. So that is performance materiality. Now the question arises, how do we set materiality level? How do we set materiality level? It is important to know our client very well, understand our clients. Without understanding, our judgment of setting materiality level will be misguided. And it's important that I say this. Materiality level has a lot to do with auditor's judgment of the scope of work, of the level at which the client is operating, and everything that surrounds the audit. Materiality, I read from a slide, materiality level are often based on quantitative factors and expressed as percentage of either it could be revenue, the segments of financial statement basically. It could be profit, it could be assets value, such as maybe we can say 1% of revenue or 5% pre-tax profit and the like. So basically that's how we set materiality level. And when we say 5%, like when we say 10% of a million, when we say set a materiality level at 10%, so of a million, it becomes 100,000. So anything, what we are simply saying then is anything above 10%, any transaction above 100,000 becomes significant, becomes material. Simply, that is what materiality and performance materiality means. I want to believe this clarifies. Moving on to reporting non-compliance to those charged with governance. Reporting non-compliance to those charged with governance. So, of course, we want to believe governance. We know that is how an organization is carrying on its business and who supervises what, who ensures that various levels of the organization, the functions, the departments are well organized and coordinated, and supervised. So that is governance. So how do we report non-compliance now? In every organization, there are people charged with governance, depending on the structure and the like. But it is easy to know. Governance is a supervisory function, so therefore it's a management function. So those that are charged with governance, let's say for example, of a company, they have MD, the managing director belongs to part of the governing board, which we usually call board of directors. Yes, is there for governance, for direction, to direct. So management staff and the hierarchy, as it could be, are governance arms of an organization. And for every organization we are auditing or to be audited, we must know who and who are responsible for the governance and who we must report to. So if we are auditing, let's say a private organization, where maybe the owner or the management staff must be reported to. But let's say, for example, we are auditing a public interest organization that we used to call at this part of the world PLCs, public liability companies. We are auditing a PLC. People that are charged with governance, like the executive director, managing director, and the like, and the board of director which they represent. And the board of director in PLC always have another arm to help them when it concerns audit and governance aspect of audit. And this is called the audit committee. The audit committee, the liaise between the auditor, the management, and the board. So if there is existence of audit committee in an organization, then audit committee members will be reported to. Okay, from our slide, unless all of those charged with governance are also involved in the management of the entity and are therefore already aware of this, that is what is in our report, our observations, matters, the auditor must communicate these matters to those charged with governance. So, and when we communicate, we must communicate in writing. Please, audit report must be in writing. Audit observations must be in writing. We used to call the observations when we are sending it to clients, that is for the report. We send it to them, say management or control report or letter of weaknesses. Management control report or letter of weaknesses. So those are the names that we use to target when we are reporting non-compliance to those charged with governance. Moving on. If the non-compliance is intentional and material, the communication should be made as soon as possible. Of course, when we are talking about it's intentional, that means fraud is observed, fraud is detected. If the auditor suspects that those charged with governance are involved now, that is another step higher. No, non-compliance is intentional. But when it's intentional and management or people charged with responsibility to govern are involved in the non-compliance, then the auditor must communicate to the next level of the management or the governance of the organization, such as audit committee, like I said. If no higher authority now exists, what shall we do? The auditor must consider taking an advice, maybe legal advice, maybe other professional advice, like going to our institute. Say, these are our observation, and it seems our hands are tied. How should we go about it? So we'll move on to qualification of audit opinion. When we are talking about qualification of audit opinion, we are talking of situation in which we are not given or we are not ready to give a clean slate. That is, we are not ready to express, for one reason or the other, an independent opinion that is clear and clean. That is, we do not have any issues during the audit. So, what are the types of qualification of opinion? Of course, you see that we have adverse opinion or disclaimer. Adverse opinion or disclaimer. So we can have a clean express of opinion, no issues. They comply with all those things they need to comply with, kept all books, method requirements. We have no issue. The financial statement, to the best of our judgment, is true and fair, fairly presented. But if not, it will either fall into the category of adverse opinion or disclaimer. So when we say adverse, what do we mean? When an auditor qualifies an opinion on the basis of non-compliance, maybe to regulation in the industry, tax rule, tax law, and any compliance matter, is an adverse opinion. It becomes a disclaimer when the scope at the planning stage of our audit could not be achieved as a result of management's trying to constrain us. Maybe because they are not responding to what they need to respond to, they are not giving us information as expressed. I want to believe that we know that auditor has access, legal access, legal backing to see into every document, every information, and to be given every information asked for or required for him or her to express our opinion. And if this is restricted by reason of management irresponsiveness, then that is they are not responding to us for one reason or the other, we disclaim and we express it in the disclaimer opinion that so and so restriction were met along our way, and because of that we could not give a clean opinion. So qualification of audit opinion is maybe clean, that is no issues. We may have adverse opinion or disclaimer. If the auditor cannot decide now whether non-compliance has occurred due to the nature of the circumstance rather than because of the restriction imposed, that is disclaimer, on him by the management, then he must consider the impact on audit reports. That is, in a situation which is not impossible, we find ourselves in a situation in which it's not a compliance issue. Is our scope is not restricted, but we still have some issues with the audit. Then we need to consider it holistically, then make best judgment out of it. Okay, moving on to reporting non-compliance to the authorities. So we've left the governance. We're talking about how should we report non-compliance to authorities. So when we talk of authorities, simply put, we are talking about governmental authority. We're talking about governmental authority here. I read from our slide. If the auditor has identified or suspects non-compliance, he must determine whether he has a responsibility to report to third party, the governmental authority. In certain circumstances or in jurisdiction, this may override the auditor's duty of confidentiality. I want to believe you know that we have a role as confidentiality, that is keeping secrets to our clients. But when need arises that we must report no compliance to authority, well, like they used to say in legal term, the veil of incorporation will be lifted. That is, we will not be bound by confidentiality role that we have to play because there's other factor that are superimposed, like money laundering. If we observe during an audit that there's a money laundering, it is expressly stated that immediately, just suspicion of it, not even sure that okay, it really happened. The suspicion of money laundering must be reported immediately. Must be reported immediately. So we report to the authority. Audit risk. Moving on to audit risk. So now we are coming home back to our audit. Now we've talked about the business risk. We want to narrow it down now to the risk involved in our audit. So we've said it earlier, we have inherent risk, control risk, and detection risk. And this risk actually could be modeled into formula. That is formula model, and it could be calculated. Audit risk could be calculated. Audit risk could be calculated. I hope we can see. Audit risk could be calculated. So the total of our audit risk is the addition of, is the multiplication rather, of our inherent risk and control risk and detection risk. The multiplication of inherent risk, control risk, and our detection risk make up our total audit risk. So just as we can see, it takes us back to our mathematics year, arithmetic year, when we are doing mathematics. So we need to bring to bear now that our foreknowledge to calculate this. So when we see AR, it simply means audit risk. IR represents inherent risk, CR represents control risk, and DR represents detection risk. And please note that detection risk is the risk that actually relates to the auditor, and is the risk that auditor can actually control, while the inherent risk is the risk that is associated directly with the industry in which our client functions or operates. And control risk is the risk that the management control system will fail or has failed or may fail to detect what is supposed to have curtailed. So in our exam, all these aspects of the model could be asked for. We could be given inherent risk and control risk and the total summation of our audit risk, and we are asked to determine detection risk. We could be given detection risk also. We could be given inherent risk also. We could be given control risk also, and we are asked to decide or calculate what the total audit risk is. So the latter is actually simpler than the former. So don't expect in the exam that they will give you inherent risk, control risk, detection risk, and ask you to calculate audit risk. But they will try to examine your mathematics knowledge so that you will need to find subject or formula. So let's say they give you, as you can see on the board, let's say they give you audit risk, they give you control risk, they give you detection risk. You have to look for inherent risk. All we need to do is we make CR and DR the subject. We make IR the subject of the formula. That is, we are going to take CR and DR to meet and divide AR, while IR stand on the other side of the equation. So in another video we are going to do the calculation of this, but this is risk modeling aspect of our work. Okay, we move on to fraud versus error. Fraud versus error. Basically, the difference between them is intention. Please don't forget. Fraud and error, the difference is intention. If somebody intended and executed an error, we call it fraud. Or should I say error? Committed a fraud. If it is intentional, when it becomes intentional, when we intentionally carry out something, it becomes fraud. But it's not impossible equally that that same thing is done but not intentional. This person did not have any intention of gaining from it. It just happened like that. So it's an error. So the difference between fraud and error basically is intention. Fraud is an intentional act by one or more person. So when it becomes more person, it becomes collaboration. And it can be so encompassing, fraud can be so encompassing that we call it syndicated fraud. That is almost all aspects and everybody in the organization or key people in the organization are involved in the act. That's syndicated. Fraud is distinguished from error, just as I said. Don't forget, intention plays the key role in the difference. Error results from a genuine mistake or omission, and it's not intentional. But when when it becomes intentional, know that that is fraud. Of course, the objective of every audit, especially external audit, final audit, is to ensure we express our independent opinion whether the financial statement is true and fairly presented. So the primary objective of every audit is not to detect fraud. Please, we should know, but to express an opinion. Expression of opinion is the primary purpose and objective of every external audit. Every other thing will follow, but they become secondary. Fraud detection may be important to us, but it's secondary. Its objective is not primary, that is, as it relates to fraud. The prevention and detection of fraud. And please know, prevention, detection of fraud actually belongs to management. It's management role to prevent and detect fraud. So now that it's not important to us, but it's management duty to prevent and detect fraud. And it's our responsibility to express our opinion. So control system should be put in place to detect and prevent fraud by the management. Okay, I read from our notes. The auditor will be concerned with fraud only to the extent that it might impact on the view of expressing his or her opinion. If it doesn't have impact in what we need to do, well, we call management's attention to it and move on with our work. However, it is particularly important in relation to fraud that the auditor maintains an attitude of professional skepticism, that is, asking questions. Even though it's not our primary objective to detect and prevent fraud, but we must always have our question in mind to everything we are working on so that we can know if anything has gone wrong and where it has gone wrong. Unless the auditor has reason to believe the contrary, he may accept record and document as genuine. So I said, because it's not a primary objective to look for fraud. So if we do not have any reasonable doubt, if the auditor is not put on inquiry, when we are saying the auditor is put on inquiry, we are talking about a situation in which an auditor observes that since something is not right, he could not or she could not really lay his hand on it, but there's a question. Something seems not to be right here. So that is a situation that we could put on inquiry. Where responses from inquiry of management are inconsistent, when we ask Mr. A concerning this particular thing and he said this, we ask Mr. B about the same particular thing and he said another thing. So it is their results, their responses are different on the same matter. It becomes inconsistent when responses from inquiry of management are inconsistent. The auditor shall investigate the inconsistency. That is, we must not leave it like that, because that is something we need to dig deeper into. Moving on, types of fraud. Types of fraud. Of course, you can have fraudulent financial reporting and misappropriation of assets. Fraudulent financial reporting versus misappropriation of assets. These are the types of fraud we could have. So when we are talking of fraudulent financial reporting, this one deals with the management level than any other hierarchy of the organization. Why did I say that? Because fraudulent financial reporting could not happen without a management hand in it. There must be an override of control. And who are the people that are saddled with responsibility to put controls in place? The management. Who are the people that could override it? The management. Before an account is signed, it must be approved. Before a voucher or an expenditure is spent, before money is spent, rather, sorry, somebody in management, maybe the manager, must sign the voucher and like. Cumulatively, when the account is being prepared and like, management gets involved. So if processes are already in place and for one reason or the other, management said it should be disregarded, they override it, then this could lead to fraud. And if it's on this level, it goes into the financial. And it can only enter into the financial because like the messengers and the like, office assistant and the like, they don't prepare the financials. They only attend to what the management or told them or instruct them to do. So that is why it's almost impossible for fraudulent financial reporting to happen without management overriding the controls. But on the level of misappropriation, which is another type of fraud, misappropriation is simply means we use an asset or company asset specifically for unintended purpose or purposes or personal purposes. When we take company car or company vehicle for personal ride and things like that, that is misappropriation. So when we use company assets for what or for personal use, it is misappropriation. And anybody can misappropriate from the lower level to the highest level can misappropriate. That is using one thing or the other for personal use or what it was not intended for. But financial reporting fraud happens when management override the controls. And because it's the management that prepares the report. So the clarification is this. Why anybody and everybody in the organization could misappropriate, management must have hand in fraudulent financial reporting. So moving on to what should auditor do when fraud is observed. Now that fraud has been observed, what should we do? What should we do? Primarily, when we observe that, okay, fraud had gone on in this organization, we need to let management be aware of it. Inquire of the management in respect of what we've observed. We assess the risk, the scope, how large, who are the people involved in the fraud, especially when we observe that it's at a large scale. We assess it because it's going to help us to determine the expression of our opinion, whether to disclaim or not. Any specific risk of fraud identified or likely to persist, we must dig deep into it, just for the purpose of our expression of opinion. We communicate the observation to people saddled with governance. We make inquiry to what management knows about it. We evaluate any unusual, unexpected relationship identified in performing an analytical procedure. Let's say, for example, we have for last year so figures and ratio analysis indicates this, but now it's showing different thing, and we could not put together the trend. Is so sharp, and we could not tie it together to the performance of the organization. Then we need to inquire. Also, there could be other risk factors. So we examine this fraud. Is it that as a result of fraud risk factors in the organization? And if there are fraud risk factors in the operations of an organization, we need to mitigate against it, especially the management must mitigate against it. And let's take a look at some of the fraud factors that could happen or be in an organization. The need to meet the expectation of third party. Let's say for any reason, maybe we want to obtain a loan and we just want to satisfy the person that want to give us the fund, and because of that a lot of things were done which probably ordinarily the organization won't have gone into. So that is a fraud factor, and we need to ensure and try as much as possible as an organization to see how we will not be in such a situation again. If remuneration of management staff is tied to bonus and the like, or performance in some key performance indicator and the like, they may try as much as possible to ensure that they meet the targets, which may lead to fraud. So it's a fraud factor. It's a risk area that could lead to fraud. So we need to examine if an organization as such to ensure that we block. We need to examine if control put in place are ineffective and see how the organization. So these are some of the fraud risk factor that the organization must, and the management in particular must, try to ensure that they mitigate against. So if there are any questions you want to ask, please send the comments to us. You can call on WhatsApp. The line is both for WhatsApp, and you can call to James Associates signing off. We are value to your business. We are value to life.